Hello, my name is Paul Spurlin. I am on faculty at Mississippi State University in Meridian as an assistant professor of finance. Today I will be presenting my paper entitled Signaling Strength and the Announced Size of an Open Market Repurchase. To begin, let me tell you a little bit about open market repurchases. An open market repurchase is just an open market repurchase announcement is an announcement that indicates that the board of directors has made it possible that a firm may be repurchasing its shares in the open market. It is no guarantee that any shares will be repurchased, only that the firm is in a position to repurchase its shares in the open market. Even though there is no guarantee that any shares will be repurchased, it turns out that several previous studies have found positive abnormal returns around an open market repurchase announcement and even in the year following the announcement. Examples of these papers are Chan, Ikenberry, and Lee in both 2007 and 2004. The most common explanation found in the literature of abnormal announcement period returns is that when a firm announces an open market repurchase, that announcement serves as a positive signal because it signals that the shares are undervalued. That is, why would management want to put the firm in a position to repurchase shares unless that firm believes that these shares are currently undervalued in the market. But as I mentioned earlier, an open market repurchase announcement is no guarantee that a firm will actually repurchase shares, and some other studies, including Jagannathan, Stevens, and Weisbach of 2000, find that a significant number of firms do not complete an announced OMR program by either repurchasing very few or no shares at all. Now, when it comes to looking at the target size and any signaling that may occur through the announced target size, let's first talk about what we mean by target size. When a firm announces an open market repurchase, it typically also announces either a number of shares or a dollar value of shares that may be repurchased. We refer to this as target size. That is from the dollar value that is announced or an actual number of shares, we can determine how many shares are subject to be repurchased on announcement day. When we talk about this target size and signaling, there are two papers that suggest, or at least two papers that suggest that the target size itself should possess a positive signal in the announcement. That is, Stevens and Weisbach say that the target size will proxy for the strength of management's information in announcing the OMR. And Comment and Jarrell go further and explain that the target size should be a strong signal of management's information because target size is the only choice variable with open market repurchases as opposed to other repurchase methods. And in fact, in empirical testing, Comment and Jarrell 1991 find that post-announcement returns monotonically increase in target size. So as target size of the announced OMR increases, so do those post-announcement returns. However, we have a conflicting view in the literature as we continue to think about target size and signaling. Chan, Ikenberry, Lee, and Wang in 2010 question whether target size will serve as a reliable and credible signal of management's information. They argue this because they posit that managers may actually use OMR announcements to effectively mislead investors about the quality of the firm. That is, because OMR announcements are not guarantees that shares will be repurchased, but that OMR announcement effect is normally a positive bump in stock price. There may be some managers that falsely signal with an OMR announcement who do not actually intend to repurchase shares, but feel pressure to use the announcement effect to get a short-term price bump. So therefore, they would be effectively misleading investors about the quality of the firm. So therefore, we have two competing thoughts in the literature. On the one hand, we have those suggesting that the target size as a choice variable with an OMR has a positive signaling ability in its own right, and we have others saying that target size is not a reliable and credible signal. So how should we answer this open question? To answer the open question, I'm going to rely on Kadiyala and Vetsuypens in 2002, who suggest using post-announcement short sales as an indication of positive signaling strength of an event. Before I mention the details about Kadiyala and Vetsuypens, let's first note that Clute, Krigman, and Leach in 2004 find that a firm's repurchase of shares increases the liquidity of the stock. Now, why would this impact our study of positive signaling ability after an open market repurchase announcement is made? Well, Kadiyala and Vetsuypens, 2002, suggests that announcement period returns are actually ambiguous as an indicator of positive signaling strength of an event when that announced behavior also increases the liquidity of the stock. So Cook, Krigman, and Leach say that when a firm is repurchasing its shares, liquidity in the stock is increasing. Therefore, if firms are actually repurchasing shares in the open market after announcing the OMR, it could be that the liquidity of the stock is increasing, and any positive price increases would be due to liquidity effects rather than the announcement signaling effect. And to get around this ambiguity, Kadiyala and Vetsuypens, who actually study stock splits, suggest using post-announcement short sales to test positive signaling strength, because short sales should decrease following a positive signal. So I rely on that motivation to actually study post-announcement short sales following OMR announcements. For my sample, I'm going to rely on short sales data from the regulation SHO mandate that made short sales data available during the 2005 to 2006 period. So therefore, I need a sample of open market repurchase announcing firms during those 2 years to allow for pre- and post-announcement returns to be calculated. I cannot begin at early in 2005, or I need to begin late enough in 2005 to allow to calculate the pre-announcement period returns, and I need to end the sample early enough in 2006 to calculate post-announcement, allow for post-announcement short selling. And so the OMR announcing firms actually occur. OMR announcements of the sample firms actually occur between February 14th, 2005 and December 19th, 2006. These firms are identified using the SDC acquisitions database. OMR announcing tickers are those firms who announce that they will be repurchasing their own ticker symbol. And so OMR announcing tickers are taken from that with the announcement date noted. As I've said, I'm relying on regulation SHO short sales data. And also for these announcement firms, I take CRISP items from the CRISP database of closing price to calculate holding period returns. And I want to make sure that I'm dealing with common shares outstanding that are ordinary common shares trading on NASDAQ or the NYSE. And so I want to pick up the common shares outstanding and the share code and exchange code out of CRISP. This sample construction technique, I end up with a sample of 391 firms. 218 of these are NYSE firms and 173 of these are NASDAQ firms. Looking at the sample as a whole, I calculate the announcement period returns for each stock in the sample. I'm particularly interested in the abnormal holding period return during the 5-day announcement period window for the OMR announcement. Announcement day is going to be labeled T equals 0, and so the 5-day announcement window will run 2 days before the announcement day to 2 days after the announcement day, and these are trading days. Abnormal holding period returns are calculated as the holding period return over that 5-day window, less the CRISP value weighted index return, holding period return for the same time period. My sample shows abnormal holding period returns over this 5-day window of 0.66% for for NYSE stocks and 1.27% for NASDAQ stocks. So there is some similarity in my sample and previous samples in that I am also finding positive abnormal holding period returns around an OMR announcement date. As far as calculating abnormal short selling, I used a trading pattern approach as shown by Christoph Ferry and Shea in a 2010 paper. To use the trading pattern approach for calculating abnormal short selling on each trading day of the sample, short selling for that day is calculated by taking the short volume for the day divided by outstanding shares for the day. Then abnormal short selling for any particular day T will be its short selling volume, or actually short selling ratio for that day, less the median short selling ratio over the entire sample period. Now, to test whether there is an effect of the announced target size on OMR post-announcement short selling, or should I say whether post-announcement short selling or the short selling following an open market repurchase announcement is affected by the target size of the announced OMR, I'm going to use OLS regression model as shown here, where the dependent variable is abnormal short selling during the 5 trading days following an announcement. So that's the sub T+1 to T+5. And then the explanatory variables or independent variables would be the abnormal holding period return during the 5-day window of the announcement and the abnormal holding period return for 25 days before the announcement. These were included to test or to control for abnormal short selling that is related to contemporaneous returns of the announcement period, and also the abnormal returns during the pre-announcement period, because it turns out that most OMR stocks have shown a period of decline in stock price before the OMR is announced, and short selling is related to contemporaneous and previous stock price movements. So we're controlling for that. Variables of particular interest are the target here, which is the target size we've been speaking of. It's the ratio of shares that are targeted with OMR versus outstanding shares. HTG and LTG there stand for high target group and low target group, based on previous research following a way of testing. Not only do I have a variable showing target size, which is the ratio of the targeted shares, but I actually divide all OMR firms into 3 groups: a high target group, the target size is greater than 10% of the outstanding shares. Mid-target group is 5 to 10% of outstanding shares being targeted, and the low target group is less than 5% of shares being targeted. I include HTG and LTG here as dummy variables, meaning that HTG and LTG would be equal to 1 if the sample stock is a member of the high target group or low target group respectively, and 0 otherwise. This is as is in the normal fashion. And the mid target group serves as the omitted class or the base case of comparison. Also, it turns out that many OMR announcements are made very near or along with earnings announcements, a regular earnings announcement for a firm. And so I include some control variables here for earnings announcements and surprises. The earned surprise here is the most recent earnings surprise that has occurred as of OMR announcement. And this is calculated as the average analyst expectation. Are calculated using the average analyst expectation. So we have actual earnings less the average analyst expectation to calculate the earnings surprise. Earnings announcement there is or earn underscore ANN is a dummy variable that is equal to 1 if the earnings announcement occurs during the same 5-day window as the open market repurchase announcement, 0 otherwise. And then I have an interaction term here between the earnings surprise and the earnings announcement to control for if any earnings surprise that occurred during the 5-day window. So as we look at the results here, the regression was actually run separately for NYSE stocks and NASDAQ stocks, as is the normal fashion in micro structure research. And we notice here that post-announcement abnormal short selling is negatively and significant related to the abnormal holding period returns around during the 5 trading days surrounding the OMR announcement. So as announcement period returns increase, abnormal short selling in the post-announcement period decreases. However, notice that for the 3 variables of particular interest, the target, the high target group, and the low target group, there is no significant relation between those variables and abnormal short selling in the 5 trading days following the announcement, with the exception of the target variable for NASDAQ stocks. This is weakly significant, as the 1 asterisk indicates it's significant at the 10% level only, but notice there is a slight positive relation there, and so we would say, we would conclude then, based on these 3 variables, that abnormal short selling does not decrease in target size for a announced OMR, announced open market repurchase. Also, we know that there is some strong significance in that earnings surprises occurring during the announcement window. We see a increase in abnormal short sales when this occurs, and this is consistent with previous research. So we look at our summary and conclusions here. Post-announcement abnormal short selling decreases with positive announcement period returns, but it does not decrease with announced target size. So in agreement with previous literature that generally concludes that open market repurchase announcements are positive signals, I also conclude that open market repurchase announcements serve as positive signals in general. But the specific question from this paper is there any difference in positive signaling based on the target size? Because we had the 2 competing ideas in the literature. Some offering that the target size in and of itself should have some positive signaling ability. Others questioning the reliability and the credibility of the target size as a signal. And although I find OMR announcements serve as positive signals in general, in agreement with previous literature, I answer the question, does the target size serve as a positive signal in and of itself? And I find no additional positive signal associated with larger target sizes. Thank you for your time listening to my presentation. I would appreciate any help that you may offer to help me develop this paper further. For questions, comments, or any additional feedback that you may want to give, you can contact me, W. Paul Spurlin, with the Division of Business at Mississippi State University in Meridian. My mailing address is 2212 5th Street, Meridian, Mississippi, zip code 39301. My preferred method of contact is to email me. My email address is pspurlin, P-S-P-U-R-L-I-N, @meridian.msstate.edu. Again, thank you for your time.